We welcome you into the MultiFamily Analysis webinar here on REI USA. I'm Dave Kohl. I'm the sponsor and affiliate manager, and I'll be your host and moderator for tonight's event. We are privileged to have Joe James with us. Joe is a CCIM, which, as some of you may know, is the highest possible designation you can get in commercial real estate. That's a lot of extra training. He's a commercial broker, but also a developer, a multifamily syndicator, and he's also the CEO and lead coach of ROI Muse, which is a company that's here to provide tools, training, and coaching for commercial and multifamily investors. So he's come to the right place. You as members have come to the right place. Keep your questions in mind as you have them. You're welcome to enter them in the chat box or send them to me. So we'll kind of keep the questions coming, and Joe will let us know. So we welcome everybody on board. And let me also just remind you, of course, we've got a lot going on here at REI USA. Live webinars pretty much on a weekly basis. Also, our online courses and our replays and everything are kept in storage. So there's a lot more on multifamily, even maybe not as much as Joe's about to give us, but a lot of that and some of the other aspects of investing. So we do encourage you to take advantage of your membership as much as possible. Anyway, let me get over to Joe. And Joe, we welcome you in, and our members are very excited to have you with us tonight.
Thank you, Dave. Thank you for that introduction. And REI USA, I know Stacy for a long time, and you guys are doing awesome job. This is really how we bring value to help everybody grow in their business. So I'm glad to be invited here to do this presentation, and happy to be here. Hi, everyone. Nice to meet you all virtually.
Thank you.
All right, we will get started. All right, welcome everyone again, one more time in all different languages possible. And Dave already talked about me. I'm the CEO of ROI Muse. ROI Muse is a company that provides software tools, training, and coaching for both real estate agents, commercial brokers, and investors. And we have trained over 3,000 people using our platform. We do multifamily syndications, real estate developments, mostly everything on the commercial side, whether office, retail, industrial, multifamily, self-storage, and whatnot. All right, so ROI Muse, again, we provide tools, training, and coaching. We also provide free trials and free training as well. So if anybody's interested in that, you can check out roimuse.com. Let's talk about why multifamily, right? Why you should consider multifamily. I assume a lot of you are single-family investors or investors in self-storage or other asset classes. So we'll go through some of the advantages of multifamily or some of the reasons why you should think about multifamily. So number one, let's talk about, before we talk about multifamily, let's talk about real estate in general, right? Why is real estate an ideal investment? So I have a typo there, sorry about that. So these are the reasons, and you can see if you look at the first letters, you can see it says ideal, right? So it's income, depreciation, equity, appreciation, and leverage. So let's take a look at each of these. So income, what we're talking about is cash flow from operating the properties, right? Once you buy an income producing property, the income is going to be, the name as it indicates is an income producing property. There is going to be an income if you buy the right property and if you're operating it correctly. Depreciation is something that IRS allows us to do. So depending on if it's a commercial or residential property, you're going to be able to depreciate it on a different schedule. And also these days, we also have advantage of accelerated depreciation and bonus depreciation. Those are going to offset your income, so it reduces your taxable income. That's the purpose of the depreciation, and it can also reduce your taxable income. And in some cases, if you are a real estate professional, it may also offset some of your other active income. So that's something that you should literally have a conversation with your CPA to see how you can benefit from this. Equity, your tenants are paying down your mortgage, and you're going to be building equity, as we go along holding the property. And then appreciation, right? There are two kinds of appreciation. There is market appreciation, which is based on supply and demand, and market dynamics. And there's also forced appreciation. Forced appreciation is where we go in there and renovate the property, and then we increase the value of the property by doing renovations and increasing the rents at the property, right? So the income at the property. And obviously leverage. You can buy real estate with 20% down, 25% down, right? So basically, you can get financing available to you. So those are some of the real advantages of real estate. And then, what are, and then why do we invest, right? If you're an investor or if you're an agent, why do your clients invest, or why do we invest, or why do we want to invest, right? So these are some of the main reasons. You want to diversify your portfolio. I know these days there's a lot of crazy stuff going on with crypto and stock market, and maybe you want to consider diversifying your portfolio, right? Just to be balance that portfolio out. Preserve capital. That's number one reason why a lot of people invest in real estate, because real estate is a real asset, right? It's not a paper asset like a lot of stocks and bonds and things like that are paper assets, but real estate is a real asset. It's a hard asset. So basically, it's one of the ways you can preserve your capital. Like for a lot of investors who have already made some money, they want to invest into real estate, and so they can preserve their capital and then grow their capital, and also get a lot of tax benefits doing that. So again, like I mentioned, it's a hedge against inflation. I know there's a lot of chatter about inflation in the market, and a lot of money will flow to real assets, like commodity, like coins and things like that, and not bitcoins and things like that, but more of gold and silver, metals, which are real assets, and also real estate, right? That's typically what happens when there's concerns about inflation as well. Tax benefits, and we'll talk about tax benefits in another chart. And also long-term wealth accumulation, right? So real estate, again, is something people want to do this because they want to accumulate wealth over a period of time. It's not a get-rich quick scheme. Real estate investing is very glamorized, so you have to be careful, right? And a lot of people out there pitching so many things and programs and whatnot, and it's very glamorized. This is one industry where there's a lot of late night infomercials and things like that. So you just have to associate with the right group of people, like REI USA, for example, right? So you have to associate with the right group of people to learn and grow as you go, right? So, and then why do we want to invest in in commercial and multifamily and self storage and bigger things? Because you can scale your business faster. When you're doing single family investing, it's going to take you a long time to scale, but once you get into multifamily, you can scale much faster and much grow your wealth much faster as well. So that's one of the literally the reason why you should consider multifamily. So another way to look at this is Robert Kiyosaki. He talked about this cash flow quadrant, right? So so you can see there are employees and self-employed business owners and investors. So most of us are going to be on the left side, either employee, we're working for somebody, or we're going to be self-employed. If you're a real estate agent, broker, or even if you're a single investor, most likely you're self-employed, right? I mean, the way you look at this is, if you can't go to work tomorrow, something happens to you, God forbid something happens to you, is that money going to continue to come, right? And the answer is always no. Like a lot of real estate agents, for example, and commercial brokers think they are in the business, they have a business, but if something happens to them, they're not able to go to work, then that money stops, right? That means that they are self-employed. They don't have a business. So the goal is to go from the left side to the right side, right? So we want to always go towards the business owner and then an investor, right? So ultimately an investor. So what is a business itself? A business is something that you create a system and process and to sell a service or sell a product, right? But you're also going to be leveraging other people's money. You're going to leverage other people's time, and you're going to leverage other people's talents, right? So literally, you create the system, you create the process, you create the products or services you want to deliver, and then you leverage a lot of people to make that business run. So initially setting up the business, you may be working in the business to set it up, but once your business is set up, you can you can step out of the business, and the business will continue to grow because you've already set up the right people and right processes for that. So, and ultimately, we all want to make a lot of money in the business and then invest that money so we can create passive income, right? So passive income is the goal ultimately. So if you look on the left side, what we are doing is we are trading our time for money, right? As an employee or as a self-employed, we are trading our time for money. And on the right side, we want our money to work for you in the investor column, right? So if you want our money's working for you, then that means you achieve financial freedom, and you don't have to go to work if you choose not to go to work. All right, so what are some of the reasons why multifamily, right? Number one is larger deals equals you getting economies of scale. So if you, instead of having 10 individual single family properties, having a 10-unit multifamily property, you have more purchase power, you have more negotiation power, and also you have basically you're getting the economies of scale. And again, if you want to run your business like a business, any commercial property, whether it's multifamily or any other asset class, will help you get there much faster, because now you're forced, right? Because none of us have enough money to go buy a $10 million property. Maybe you do, but most people don't have enough money to go buy a $1 million property, right? But once you shift that mindset to say, now I can work with other people, I can partner with other people, I can bring in investors in my deal, then that's going to force you to become a business owner, right? So literally going back to the cash flow quadrant, you'll be forced to go to the right side very quickly once you start working on commercial and multifamily properties. Relatively low risk compared to other asset classes, because at the end of the day, it's housing, and everybody needs housing, right? It's one of the basic needs for every human being, is housing and shelter and food and clothing. And this is, housing is, is essentially falls into that shelter, right? So it's related compared to other asset classes, it's most investors perceive this as a lower risk, because everybody needs a place to stay. Uh, and then it's less competition compared to single family. I know these days the market is crazy, and it's almost impossible to find anything reasonably good deal in single family. And multifamily, it's also very hot, but there are very less people looking for multifamily deals because of the specialized knowledge it requires to find and operate and syndicate multifamily deals. There's plenty of financing options in multifamily, just like single family. You have Fannie Mae, Freddie Mac, FHA, bank, and seller financing and other financing options. So there's plenty of financing options available, and shorter leases, right? So most of these properties are going to have, a few months lease remaining, or a year of a lease remaining. So that what that means is you can go in there, and when those leases turn over, you can go in there and improve the property, right? You don't have to wait a long time. You can literally go in there and improve the property, and increase the rents. And we'll talk about how to increase the value of the property. And opportunity to refinance, take money out. There's a lot of exit strategies. You can refinance and hold. You can buy, renovate, sell. Do BRRR. A lot of those options as well. And again, it has all the benefits of real estate investing. Ideal. Just remember ideal, right? Income depreciation, equity appreciation, leverage. It's only at a much larger scale, right? So because you can scale much quicker with all of these advantages as well. All right, so some of the tax benefits. I'm not a CPA, and I don't pretend to be one. So make sure you talk to your CPA, your finance advisors about this. So depreciation usually creates tax deferred income, right? So basically, you're using the depreciation to offset your active or your passive income at these properties, and then you can take advantage, if possible, with accelerated and bonus depreciation. You can do 1031 exchange. I know there's a lot of talk in the market about the future of 1031 exchange, but right now it's in the books, and we can take advantage of tax deferred capital gains through 1031 exchange. Low income tax credit opportunity zones. A lot of cities have incentives for you to come and build housing, where they need. So there's a lot of opportunities with tax credits and tax, a lot of and opportunity zone and things like that. Then people have people who have self-directed IRAs, so that you can invest from your self-directed IRA. It's easy to find a lot of investors that have a self-directed IRA or solo 401k, things like that, which are tax deferred plans where they want to invest into multifamily deal. Because in my experience, in my opinion, more people are comfortable investing into a multifamily deal as a passive investor compared to doing a single family property, right? A lot of people are looking for long-term 5 to 10 year hold periods. So let it ride kind of thing, right? So they can get a good return on their money. And cash out refi, if you can buy a property with the right price, improve the property, increase the value of the property, you can do a cash out, and whatever the proceeds you get from your cash out is typically tax-free capital, right? Basically, again, discuss with your CPA about what the possibilities are. So to sum it all up, so multifamily allows you to scale your business through partnerships and syndications, right? So, that is something that you have to be open to, partnering with others to grow faster. So everybody can, and it gives you the opportunity to create generational wealth and also achieve your financial freedom faster. So that's literally, to sum it up, why people go from single family to multifamily and commercial investments. All right, so what is stopping you from doing that, right? So once we know all of this stuff, so what is stopping you, right? And then, as I mentioned that, we do coaching and training, and we talk to a lot of people on a daily basis. For the most part, it is, I don't know how to run the numbers, right? So I don't know, I don't have enough experience, and I don't know how to get started, and I don't have enough money, right? It usually falls into one of these 4 categories. I mean, all of these are valid in any given situation, but these are all easily solvable, right? So I don't know how to get started. You're part of a REI USA group, right? Literally, there are a lot of people here who can help you. I don't have enough experience. Again, along the same lines, right? Your coaches and mentors and everybody here who can help you. I don't know how to run the numbers. That's something maybe we can teach you how to do that, right? It's not that difficult once you understand the concepts, because we have the tools that calculates all the numbers for you. You don't have to worry about doing any of the heavy calculations. You just need to know how to analyze the property, know the concepts, and know what numbers to use, so that we can calculate the returns and projected returns and all of that stuff. I don't have enough money. Obviously nobody has enough money, right? And most of the time, I've heard Stacy say that, and she's never put any of her own money into any deals, right? So you have to be open to the idea of that you have a role to play here. You have to find the deal, analyze the deal, put the package together, and then you bring in other investors to invest into your deals. So those are that's typically how you scale in your real estate business anyway, right? It's not with your money. It's all, we all heard the term is using other people's money is literally the only way to scale in your real estate investment business. All right, so remember this one, obstacle is the way, right? So whatever is stopping you from going to the next level, whether it's not having enough money, not having enough knowledge, or not knowing how to run the numbers, whatever your obstacle is in your way from going from where you are currently to the next level, right, is the only path to go forward, right? You have to know how to solve the problem. We are all entrepreneurs, and as entrepreneurs, our number one job is to solve problems. So whatever is standing in your way, you just have to smash right through it, right? So what so this is literally, there are so many people who can help you get there. You just have to know that the only path to your future is going through those obstacles. All right, so now let's get into a little bit of the math side. So when you come into commercial deals, you need to know how to analyze deals, which is very important because commercial properties are valued. Residential properties are valued typically based on comps or comparative market analysis. Now we do a CMA, we look at the comps and then come up with a value for the property. Commercial is analyzed differently, right? We do what's called an income capitalization approach, right? So basically we're looking at the income at the property to value the property, right? So we're looking at the potential income that can be generated by the property, and then we use that and what we call a market cap rate to price the properties, right? So we need to understand how that works. So basically, when you look at any business, you're going to have operating income because whatever you sell is going to bring some revenue, and then you're going to have operating expenses, right? So operating income minus operating expenses gives you the net operating income. Very simple concept, right? And literally, that's all there is to know about how to analyze a commercial property, right? Because what the goal is to calculate the NOI, or the net operating income. NOI, in essence, is just operating income minus operating expenses. So let's expand on that framework a little bit, because to analyze, we need to use a slightly different framework, because we need to understand the potential of the property, right? So the way we do that is we start with what's called potential rental income. So potential rental income this is something very important concept, right? So make sure you write this down. So potential rental income is the maximum a property can generate, if the property is 100% occupied and also leased at market rates, right? So we have to find out what the market rents are. And if the property is leased at, let's assume we can lease all of our units at that market rent, then that is a potential rental income, and we are 100% occupied. So that is a concept that a lot of people struggle with, right? So everybody tend to want to look at the past performance of a property. You're going to miss out a lot of opportunities doing that. So you have to know what potential rental income is, and the keyword here is potential, right? So remember that much. Potential is a keyword. We're looking at what is the potential for this property, right? So that is one thing that we have to understand first, and that we do that by doing market analysis, like looking at your competitor set and all of that stuff, and we'll talk about that. And then every property has a loss. Now, most of the time, the loss is going to come from vacancy, turnover vacancy, right? When people leave, you may have, the unit might be vacant for a month or two before you lease it up, and you're also going to have loss from loss to lease. If you're renting your units below the market, then that's called a loss to lease. And then obviously you have loss from bad debt and collections and concessions and things like that. So there are different kinds of losses that can happen at the property. And then we also have opportunity for other income. And multifamily actually gives you more opportunity to create other income at the property. So a lot of the time that is literally deals are getting really tight and tight. So we are looking at properties where there's an opportunity to add other income. Now, other income could be something like pet rent, right? It could be washer dryer, laundry facility on site, or it could be washer dryers in the units. It could be cable and internet, like technology package. It could be covered parking. There are a lot of things, a lot of ways you can actually increase the rents at the property or income at the property by providing more facilities, right? Providing more amenities and things like that. So that's what's other income. And expense recovery income in multifamily, it's called RUBS, RUBS. It stands for Ratio Utility Billing System. This is essentially taking some of your expenses, most of the time utilities like water, sewer, trash, etc., and billing it back to the tenant, right? So basically, the landlord is going to pay for these expenses, but then in addition to their monthly rent, you're also going to send them a bill for reimbursing these utility expenses. So that's literally another source of income. So it's an income line. That's why it says income, right? But what we are doing is we are recovering some of our expenses from the tenants, and then operating expenses, right? Operating expenses is everything that is required to operate the property, from property tax, property insurance, your salaries, property management, your repairs and maintenance, contract services like pest control, landscaping, pool service, and everything else, right? So office expenses, marketing expenses, all of that's that's a big bucket in operating expenses. So that again brings you back to net operating income. So we went from operating income minus operating expenses equals net operating income to another framework here, which is the one that we are going to use in analyzing multifamily properties. So potential rental income minus losses plus other income plus expense recovery income minus operating expenses gives you the net operating income, right? So if you remember this framework, if you learn this framework, you can analyze, and I'm not kidding, you can analyze any commercial property, including multifamily, self-storage, or any asset type. You can use the same framework. This same framework is used to analyze a 5-unit property, and this same framework is used to analyze a 500-unit property. So this same framework is used to analyze a $200,000 property, or a $20 million property, or a $50 million property. So this is how it is. This is how commercial valuations are done. So if you understand this framework, you can go after $100 million property if you want to, and you know how to analyze that, right? So, but obviously it takes some practice and everything to know the different nuances of different asset classes. But the basics is understanding this framework. Now there are a couple items that are below net operating income, it's not included in that. So anything that's a capital expense, like replacing AC unit, or maybe a roof replacement, things like that are not considered operating expenses. They're considered capital expenses. So they are not included in the net operating income. The reason why this is so important is this NOI is what's used to calculate the value of the property. And obviously mortgage payments is also not included. So you take NOI and net operating income minus capital expenses minus mortgage payments gives you the net cash flow, right? So literally that's your cash flow, that's your income at the property, right? So now we have completed the framework. We know the net operating income, which is used to calculate the value, and then we also know how to calculate the net cash flow, which is your income at the property, right? So that is essentially the framework for analyzing any commercial deal. Now let's talk about some of the performance measurements. So we need to look at how do we calculate the returns of the property, right? So number one, so we are going to introduce 2 more frameworks. So if you think about it, what happens when you acquire a property? You have to buy the property. That means you have to do an initial investment, right? Then you are going to hold the property for, let's say, 5 years or 10 years or whatever your hold period is, right? Based on whatever your strategy is. Maybe it's 3 years or 2 years, whatever. So during the whole period, you're going to know how much cash flow is coming from the property. And then at the end of your whole period, you're going to sell the property, and then you're going to get the sales proceeds, right? So literally, I'm not going to go through all of this. We just went into details of this one here, but this is very simple, right? You can, it's a purchase price plus any cost, minus the loan amount gives you the initial investment. And when you sell the property, sales price minus any cost minus the loan payoff gives you the sales proceeds, right? It's very simple to calculate these. So we know how to calculate the initial investment of the property based on when we buy the property. We know how to calculate the cash flow at the property each year we hold the property, and we know how to calculate the sales proceeds, when you sell the property, right? So based on these, so we know where these are coming from and just pulling them out of these frameworks. And now we can calculate all of our metrics. So value is, or the price of the property is net operating income divided by cap rate, which is literally then net operating is here, and cap rate is something that we get from the market, right? So once we can know how to calculate the net operating income, we can divide that by the cap rate to calculate the value. And so cap rate and NOI can be also calculated using the same equation, right? You just, depending on if you have two of these available to you, you can calculate the third one. That's how this works. Now, then what is cash on cash return? So cash on cash return is calculated based on your initial investment and net cash flow. So your net cash flow is coming from here, and your initial investment is coming from here. So we know how much money we spent to acquire the property, and we know each year how much cash flow is coming from the property, and then you take the cash flow divided by initial investment, you get the cash on cash return, right? So it's very simple to calculate that. And ROI, typically in here, this net cash flow, we are also paying the mortgage on top of that, right? So the mortgage has an interest portion and the principal portion, right? So to calculate the true return of the property, we also want to include how much of the equity is being paid down by the principal of the mortgage, right? So we also add that principal portion back, not the entire mortgage payment, only the principal portion back into our cash flow, and then to calculate another metric. So that gives you a true return of the property, right? On to say what is the annual ROI. And typically your ROI will be a higher percentage than your cash on cash return, right? Because you're also paying down the mortgage. Now, the most important metric, in my opinion, is internal rate of return or yield. So most people refer to this as yield, and in the technical term is IRR or internal rate of return. And the reason why this is so important is because this is the only metric that, and out of the ones we have looked at so far, that takes into account everything, the full life cycle of a deal, from acquisition to operations to disposition, right? From purchase to operations and also the sale of the property. So we look at the initial investment, we look at the cash flow for cash flow each year from operations, and we also look at the sales proceeds to calculate this number, right? So this is a little bit more complicated to calculate, but don't worry about it. That's why we have tools for you to calculate that, right? So that is one metric that everybody should be aware of, how to calculate the yield at the property, and because that's how we know how much returns you're going to get. So what we're going to do now is we're going to take a look at a quick case study. I'll go through this very quickly, and if you have any questions, we can answer at the end, like Dave said. So we're going to do a small case study. We've done like 180 unit case studies, 250 unit case studies, or even a fourplex case studies. But I picked this one because I think this one is good to illustrate how to do a simple deal. All right, so Sunset Apartments, 16 units. And the target yield, or how much our return we want, is 15%, right? That is kind of what our investor wants, or that's kind of what if you are the investor yourself, let's assume you want to get a 15% yield for the property on a 5-year hold period. Price, beautiful, right? Price by the market, and then how do we even make an offer if they don't even give you a price? So we'll take a look at that also, how to do that. And then what we have, the data we have is we have the rent roll at the property, and you can see there are 16 units here. We have 6 1-bedrooms, 6 2-bedrooms, and 4 3-bedroom units. There are some 5 of them are vacant, but everything else is rented here, right? So that data that they gave us, right, we have access to that data, is the current rent roll at the property. Now, let me walk you through the steps involved in analyzing multifamily properties, and these are the same steps you will use to analyze any commercial property, right? Step 1, we're going to do rent analysis, which is the current rent analysis and also the market rent analysis. Step 2, we're going to look at the financial analysis. We're looking at the trailing 12 months or the last 12 months of P&L data, profit and loss data, and we're going to analyze that. And then step 3, we're going to develop our business plan, right? Because you're going to buy the property based on what you plan to do to the property, right? Based on your analysis and what you see the potential at the property. So we're going to develop a business plan for operating the property and improving the property, which is usually called as a CapEx plan or CapEx budget. And we are also then, based on all of that, we're going to create our pro forma, or the projections for the future. And then we're going to underwrite the deal, and based on our target yield, depending on how much return you want, you're going to calculate a maximum offer, right? That's step 4. And step 5 is now we're going to test a lot of our assumptions, right? Because we're making a lot of assumptions along the way. Now we want to test all these assumptions to make sure that if things don't happen the way that we are projecting, then what is the downside? And we also want to see what's the upside, right? And that's why we create what if scenarios. We'll create like best case scenario, worst case scenario, things like that to see if the deal is still, meet some of our criteria. So, and then finally we have to make the decision, right? Go, no go decision, and then you present your deal to your client or your investors, right, to see if they'll fund it. And also you present the deal to your lenders as well, right, to see if they'll fund it. So that's literally the step 1, 2, 3, 4, 5, 6 of what we follow. And again, like I said before, this is the same process you do if you're buying a $200,000 property or if you're buying a $20 million property. It's the same process. All right, so let's look at our case study. So what we did is we took that rent market, our current rent, and we summarized it, right? So you can see there are 16 units, and these are the average square footage for each of the unit type, and these are the average rents. And we're getting about $1.06 here, right, on the average rents, $1.06 per square feet rent at this property. Now, then what we do is we go to the market and do market analysis, and we pull out comps, right? Now, again, we're talking about comps here, but we are not looking at the price of the property, but we're looking at the rent comps here. So we have identified, in this case, 9 properties from property 1 to property 9. And we are looking at, each of these are very similar, total unit to, ours is 16 units. These are the biggest one is 24 units. So they're all within the same range. We are not comparing a 16 unit property to a 100 unit property, right? So they are all very similar. And we have collected the data for the square footage and the rents for the 1 bedroom, 2 bedroom, and 3 bedroom for each of these properties, right? So now what we're going to do is we're going to summarize that data, right, our comp data, and then we come up with the market rent summary. So you can see that we have the rents here are about $1.16 when we look at the market. That's the pro forma rent. These are our current rents at the property. So you can see for the 1 bedroom we are getting average square footage is let me go to the next one. We can do side by side. So okay, so this is our current. In the current, if you look at the 1 bedroom, we're getting 730, right, as an average for our 1 bedroom units. When we look at the market, we think that we can push this to 770 because other properties are getting 770, right? When we look at the 2 bedroom, we are currently getting 810, and the market data shows us that we can possibly get $900, right, for the 2 bedrooms and so forth, and 975 for the 3 bedroom, and the market rent shows that we can get $1,100. So this is literally the difference between 1,100 and 975 is called the loss to lease because we are currently leasing below market. Now, our next thing we're going to look at is what is your business plan? How do we get to this number or higher, right? Maybe something we can even push the rent to 1,200, right? If we do some amenities and do some upgrades and things like that. So the part of your analysis is figuring out what can you do to the property to increase the rents at the property, right? So literally, by increasing the rents, is that's going to increase your NOI, and when you increase the NOI, the property value goes up, right? So that's why it's very important to understand the whole concept of how property valuations are done and the importance of NOI. And everything that we do is with one goal: is how can we create more NOI? How can you increase your net operating income at the property? All right. So now what we're going to do is we're going to log into our system, and then we're going to underwrite this deal, right? So, all right, so this is ROI Muse. It's roimuse.com or app.roimuse.com. And when you come in here, if you have not, you can create, click on the start your trial. It gives you a 15-day, 14-day trial. You can play around with it, see if you like the tool. Now, once you log in, these are all the tools we have. So we have commercial deal analysis, which is what we are going to use today. Then we have commercial lease analysis if you are a commercial broker, or it's also for investors who invest in office and retail property to understand different lease structures and how to calculate the value of the lease and so forth. And then we also have residential calculators, the BRRR analysis, the rent analysis, fix and flip analysis. We have the construction rehab estimators. We also have a multifamily pro forma builder, and we'll be adding more tools. So these are some of the tools we have. Then we also have some free tools here that you can use for free forever that will help you understand some of the financial concepts, right? And we have training for each of these as well, right? So those are some of the tools we have. So we're going to go into our commercial deal analysis, which is, you'll just click on access here and go into that. So I've already opened one up here. So this is what it looks like, the commercial deal analysis tool. And I'll walk you through how to analyze this property. So we are not going to focus on this one. This is more for presentation purpose. So we're going to go into the analysis, right? So what is the acquisition price of the property? we have no clue, right? They said price by the market or make an offer. So let's just start with, I'm just going to make a guess that this property is going to be around $1 million, based on my knowledge of the market. So $1 million is, I'm just going to use that, right? And the acquisition cost, let's say we're going to be spending about 1% for the acquisition cost, which is typically for your inspections and things like that, right? Or due diligence cost. So 1% there. And our loan, based on what the lender has given us, is about 75% loan to value. And they're going to be able to do a 4% interest rate and 25-year amortization and a 5-year term on the loan. And the loan cost is about 1%, right? So typically 1% is, for your appraisal and your origination lender cost and things like that. So those are all in there. Now you can see as soon as I put in this information, my initial investment is already calculated for you, right? I showed you the framework, right? Your acquisition price plus your costs minus loan amount is the initial investment. So that's already calculated for you. You don't have to do anything further. Now, how long are we going to hold this property, right? That's the disposition assumptions. And you can see that everything with the gray background is already calculated, right? So you don't have to input that. You want to only focus on the white background cells. So we're going to hold this property for 5 years. And we think that we can sell this at a 6% cap rate, when we sell the property. And it's going to cost us about 7%, 4% to sell the property, commissions and, title and closing costs and everything, right? So we put that in there. Now, still, what we had to do is we had to look at your operating assumptions. So this is your framework, right? We talked about potential rental income minus losses plus other income plus expense recovery income minus expenses. Operating expenses gives you the net operating income, right? So these are all the input fields. Everything below is calculated for you. Because they are all gray, right? You can see. So let's start building this. Before we build it, what I'm going to do is I'm going to go to my rental income worksheet here. And I've already input our case study here. So the 16 units, you can see there are 16 units here. And we know 11 of them are occupied because 5 of them are vacant. And we know what the market rents are because that's what we did from the market rent analysis. We know what the current rents are because we did the summarization of our current rent roll. And basically what it comes down to is our potential rental income. Remember, that's a potential number is $173,000, right? Currently, the property is generating $109,000 because of the vacancy and because we are leasing below market. Now, the loss right now is 37%. Loss from vacancy and loss to market or loss to lease is 37%, right? So that is a huge potential. This is how millions of dollars are made. So if you find a property that has a number like this, it's going to be your, this is a, you'll be chopping your lips, right? Because this is a good, possibly a good deal, right? But just looking at the rent roll itself. So let's go ahead and take these numbers and start working with it. So save and close. So in that you can see those numbers get applied here. And right now it's a 37% loss. Now what we had to do is now we had to, let's look at just focus on year one first, right? So year one, there's no other income at the property right now. There is no expense recovery at the property right now. And we know the operating expenses are based on our P&L analysis. It's about $55,000, right? So is what the current expenses are at this property. Okay, so we have that much data available to us. So now we can see that everything else is calculated for you, right? So you can go down this list and see what your returns are. Your cap rate is 5.4. Your cash on cash return is 2.4%. Not very good. And so forth, right? So let's go on and finish. So if I look at this property and I'm looking at my returns are not very good at this property, right? Only 2.43% in the cash on cash return side. So how do we analyze this property so that we can, make sure that we're covering everything, right? Again, you go back to your operating assumption. This is where you're going to put in your business plan. So let's say the income is going to go up 3% a year. That's the potential rental income. Market rents are projected to go up 3% a year. Now we can reduce this 30% down to, let's say, 37% down to 30% in year one, and maybe to 20% in year two, and about 10% in year three. By year three, we have fully stabilized the property, right? And then after that, we'll just keep it at 10% loss because there's always going to be some vacancy and some other issues there. Now we can say that other income, we're going to add some parking lots and car covered parking and things like that, and we can get about $1,000 other income in year two. Nothing in year one, and then maybe 2,000 in year three, 3,000 in year four, and so forth. And for expense recovery, let's say we can also do maybe about $500 in expense recovery, and then $1,000 by year two, and $2,000 by year three. right? So maybe we can do some expense recovery or bill back and generates more income. Now we also have to look at capital expenses, right? Every property is going to need capital expenses. So let's say we're going to put in $5,000 capital expenses. So typically we do like a $300 per unit. So 16 times 300 is about 4,800. So I'm just rounding it up to say $5,000 for the capital expenses. And we're going to put that throughout the year. So now that we are done with all of our analysis, right? You can see everything is calculated here instantly. Now what we have to look at is, okay, what is the price that we want to pay? Let me go ahead and save this. And we look at this deal and we look at, okay, we call the broker and say, okay, we're going to send them offer for $1 million. And they say, nice try, right? Don't even bother, right? Because you're not even close. We have many offers above that. So this is where the target yield analysis, right? So what is our criteria? We want to get at least a 15% return on this property, right? So we know if we want to get a 15% return, we know we can type in here and say 15% and click on this little button next to it to say recalculate the price. And if I did that, it will tell you that I can pay up to $1.8 million to get that 15% yield on this property based on my business plan. Now that is my top line offer, right? 1.7 or $1.8 million. It literally calculated that for you in, you can see that here, 97 milliseconds, right? So now that's my maximum offer. I'm going to make a note of that. And then what I'm going to do is I want to try to see, okay, I want to get a 20% deal. I want to create some cushion for myself, right? I'm going to do 20%. And I'm going to look at this and say $1.6 million. Okay, what if I go 25%? All right, 1.5. Okay, so I'm going to make an offer for 1.5, right? Because now that is going to give me a 25% yield at the property. And that is more than enough. When my investors are looking for 15%, then I can get the remaining yield, right? As the sponsor or the promoter of this deal, right? So, this is when you call the broker and say, okay, we are sending an offer for $1.5 million. He said, okay, send it over. And then he calls you back in 2 days and say, we have many offers, and we are asking for the best and final. And, and now you have to think about, okay, how much more do you want to pay? We know that our target yield is 15%, right? So we are getting 25% now. So we have that 10% to play with. Maybe you will come back and say, okay, I'm going to maybe go down to 20% here and calculate the price based on that, $1.65 million, to say, okay, here's my best and final offer, $1.65 million, right? So this is how you calculate the maximum offer very quickly. Even though, remember, we started with no price, right? We didn't even know what the price was, but we were able to calculate the price, based on how much return we want to get, right? Not based on anything else. Now you look at the other metrics to see if does it make sense at all, right? So now one thing we forgot is we also need to add some capital. We're going to also, our business plan also calls for improving the units, right? So we need about $100,000 to improve the units. So I'll just make this one $100,000 because we need to get more capital for that. So now that dropped my return to 15.9, and if I still want to go to 20%, I'll recalculate the price again. And now it's 1.443, right? So now our final offer was revised to $1.43 million. And now when you look at the debt service coverage ratio, it's only 0.9. We're not generating enough income to pay our loan at the property, and the bank is not going to go along with that. So either we had to put more down payment here. So if we put 70%, then our yield goes down to 18%, but still our we're still not making the debt service coverage ratio requirement. So we'll just keep it at 75%. Maybe we can go to the bank and negotiate some interest only. So let's do an interest only for 6 months. And that will get you closer to the 1.2, what the bank wants, right? So maybe, that's literally how you can make it work, right? If you want to do 1.2 as a minimum, and we can recalculate that. So now I revise my offer based on the lending available to me to say $1.4 million. Right, that's the maximum offer I can make at this property. That will satisfy the bank's requirement. It will satisfy my investor's requirement, and it will satisfy my requirement of how much money I want to make. So that is how you underwrite a property, and it's a very powerful tool. You can add pictures and a lot of stuff, and you can create multiple scenarios and everything very easily, right? And then I'll show you how to create another scenario here. All you need to do is click on Save As. Well, okay, Save As, and I'll just call this one worst case, just to show it, worst case, save it. And let's say worst case scenario is the market is down, we can only sell this at 7% cap rate, right? So now I can see that my return went down a little bit. Or let's say worst case scenario, the market is completely down and we can only sell it at 8%, right? So now let me save this one, and now we can compare side by side and say in the best case scenario, we're going to get a 24%, almost 25% yield. In the worst case scenario, we're still going to make money. We're still going to, our yield is only 12%, but we're not losing money, right? So literally, this is how you want to, test your analysis, right? To say, okay, in the worst case scenario, this is a good deal for me because, obviously my potential is very high, but in the worst case scenario also, I'm not losing money, right? So I'm still making a 12% yield on the property, right? So should be good to go. So that's how you make your decisions based on your analysis. All right, so now we'll go back to continue with our presentation. All right, so how do you split profits? Now, we talked about a lot about the opportunity to partner with your clients, partner with your investors. So how do we split profits between investors and the sponsors of the deal, right? So this is one example. There are several different models out there. Usually, it's a very simple 80-20 split or 70-30 split, things like that. So 70% of the returns and the cash flow from operations and from the sales proceeds go to the investors. 30% goes to the promoters, or 80-20, or you can do it any way you want. It's all negotiable between you and your investors, right? But what we see in a lot of syndications is like 80-20 and things like that. I've also seen 50-50 on smaller deals, right? Depending on your investor and how much returns they're looking for and how good the deal is. Now, one of the model that we want to look at is called a preferred return and promote model, right? And I'll show you an example of that. So literally, so this is the cash flow of the deal we're looking at. So we need about $430,000 to buy this property. That's a negative cash flow, right? That's how much money we spent. Then each year we're going to get this much cash flow. And when you sell the property, you're going to have a $500,000 sales proceeds after you pay back the investor money, right? So digitally, we need to figure out how to split that money, right? So the one way to do that is, so this is the equity we need, so this is a one model, right? All of this is negotiable. Let's say the investor is going to put in 90% of the money out of the 430, and we're going to put in 10% of the money, and that could easily be covered by our acquisition fee. I'll show you some of the fees, right? And then, we're going to offer them a 7% return on this deal, preferred return. And then anything excess on top of the 7%, we're going to split it 50-50, right? So that's the model, that's the proposal, and they agree to it. And then at the end of the deal, we're going to split the sales proceeds 80-20 also, right? So this is just one model. All of this is negotiable, right? So this is just an example. Now, the potential fees as a deal promoter, or so it could be, you can charge 1 to 3% acquisition fee. This is a smaller deal, so it's a 3% acquisition fee. So that $37,000 acquisition fee could cover almost your 10% in your skin in the game, right? So that is one way to look at it. And if you have construction management, so you're doing a $100,000 construction, if you're going to manage that construction, project manage it, or do the construction manager, you can charge a construction management fee. You will charge an asset management fee every year because you're managing the property, right? And you're not managing the property, there'll be a property manager, but you're managing the property manager, and you're also taking care of the financing and the tax reporting and all of that other stuff. So we can charge a fee for that, and you should charge a fee for that. And then when you sell the fee, you can also charge a disposition fee, or and so literally, again, this is a list of potential things. Doesn't mean that you're going to get all of this at every deal, right? But these are potential money you can get at each deal. So you can see now, you can potentially, in this particular deal, in this example, there's a potential to get about $132,000 of fees, right? And then you're going to get a good return because you also own 10% of the, you own your own money, making money in the deal. That's a 10%, but you're also getting a 20% split at the back end and things like that, right? So literally, those are some of the ways you make money. And let's walk you through the whole model. So this is the cash flow at the deal. So initially, the preferred return is everybody's, the investor is going to get $25,000 preferred return based on the 7% of their 389 investment. We get nothing because there's not enough cash flow. There's only 25,000, and we give all of that to them. In year 2, we are getting $41,000. So they get $27,000, which is the 7% of that. And then we get 7% because we also have some money in the deal, like 43,000. So we get $3,000. So now the 27 plus 3 is only 30, right? We have 41. So what do we do with the remaining money? The remaining money is the excess cash flow. So that is, we're going to split 50-50, right? That's what we proposed, right? So you can see now that $10,000, $11,000 is split 50-50 between the investor and promoter. And this investor could be a group of investors, right? We one investor or 10 investors. And the promoter could be one person or a team of people, right? Entity, right? Whichever way. And then at the end, when you sell the property, you're going to get, the investor is going to get 794. That also includes their initial investment of 389. That's the money back to them plus the profit share. And then you're going to get 144. That includes the 43,000 that you put in the deal, plus about $100,000. So you're making about $100,000 at the end of the deal, plus you all these fees about $136,000. Like literally, that is how the splits work. For in most, this is a one way to look at it. So the most important thing is, investors get 20, 25, 22% return. They wanted 15%, right? We are giving them a 22% return, and we are getting a 40% yield, 41% yield, right? So literally, you're almost doubling your money every year by doing deals like that. And then on top of that, you also getting all these fees. That's going to help you run your business and also maybe invest into the next deal, right? So literally, that is how that's the power of syndications, right? Syndications doesn't mean that you have to do a 200 unit property with 1,000 investors. You can just do it with two people, two investors or one investor, right? It's all about negotiating that deal, because you're finding the deal, you're managing the deal, you're taking care of all of that, right? The investor just want to invest their money and make their money grow, right? So literally, by combining somebody who has the energy and the know-how and somebody who has the money, this is how we can scale our business very fast. All right, so give me 6 hours to chop down a tree and I'll spend the first 4 hours sharpening the axe. So this is a famous quote from Abraham Lincoln. So somebody told me the other day about, oh, I'll just buy a never mind. So but the idea here is, if you want to do something, you have to spend enough time learning, right? I mean, I applaud all of you to being here today and being part of REI USA and things like that. This is how you learn and grow, right? Because first thing is you have to acquire the specialized knowledge, but then you have to do some action with that. Once you have the specialized knowledge, you have to act on it, and that's when good things will happen, right? So, but the essence of the purpose of all these groups we have here is to literally help you with acquiring that specialized knowledge. So take full advantage of that, and I congratulate you for being here today or being part of the group. All right, so back to ROI Muse. Like I mentioned as before, we provide the software. We are a software company that provides training and coaching, right? So if you want to take a look at our software, if you want to do give it a trial, you can start a free trial by going to our website. You go to a website and click on free trial, and then you can play around with it. If you want some free training, we also offer some free training on residential. So we have literally 2 training tracks. One is for residential and multifamily investments, and other one is for commercial real estate brokerage. So if any of you real estate agents or anybody wants to get into commercial real estate brokerage or commercial real estate training, we also offer that. And these are both free training that we offer, right? So you can also sign up for free training. So go to, you can email support@roimuse.com and we can send you the link, or we can send you this presentation to Dave and he can distribute it to all of you guys. Then you can go and sign up for the free training and free trial if you want to check us out. So that brings us to end of the presentation, and let's see if you have any questions, Dave.
Yes, we do. I've got 3 of them so far. One, I want to move to the top of the list. A great question. I love our members at REI USA. The question generally, and I'm going to add to it, was about you were going through the rent comps, and the question was, what do you look at? How do you get those? And I'm going to add to that. This was a question I had come up in a separate investors meeting. And as far as getting the investment comps, bringing up other considerations that, there may be other apartment buildings or, rentals down the street or within the half-mile radius, but maybe they have a pool and a clubhouse and yours doesn't. Maybe they include utilities and you don't. Maybe they have in-unit laundry and yours does or doesn't, or vice versa. You're better, you're not as good for specific reasons. So when you're looking at comps for this type of project, even using your case study, so where do you get and what should you be looking for in comparison?
Oh, no, that's a great question. So one thing I'll tell you that, you can have two properties across from each other. It could be completely different, right? Maybe one is in a better school district, right? Or one has a better transportation, or one has more amenities, right? So that is why we get paid the big bucks, right? Because that is the unique skill for you to, I mean, it's not that difficult, right? I mean, you have to go visit the properties, talk to them about, get the unit plans and the floor plans and amenities, and, look at the pictures. And so you're literally doing, I mean, the way you approach it is, first is the main things, right? Is it in the same school district? Is it all similar, right? Is it a similar property or not? So we are picking similar properties to compare, right? And then if you see that another property is getting a higher rent, then you have to ask the question, why is that, right? And then you have to dig deeper and find out why they're getting the higher rent. It could be just simple as they have better operations, right? Sometimes you run into, especially on a 16-unit property owned by a mom and pop operator, they don't want to raise rents. Some of these tenants have been living there for 10 years. They are in cahoots, right? They don't want to raise rents, or they have not kept up with upgrading the property. They don't even know what the market rents are. So those will be the cha-chings. But if not, then you're looking at, okay, now they have a pool, like Dave said, right? Okay, now can I add a pool, to get the rents higher? Or how much is that going to cost you? They have nice granite countertops, and they have nice appliances, and they have nice flooring and nice upgrades in the units. No, can I do that to get that higher rents? If I do that, will I get the higher rents, right? If I, and then if you decide that, if you do that, you're going to get that higher rents, then how much is going to cost you? So that's how you build your business plan, by asking those questions, right? And making a judgment based on your analysis to say, okay, now if I can upgrade these units. So remember, I put $100,000 into renovation budget in there. So basically my assumption in that case was, I need $100,000 to upgrade these 16 units, and also add some exterior amenities, right? Maybe add some, pergola, and, nice play area, and also give the building a nice pop, right? By using good exterior color paint and things like that. So, and also add some covered parking, maybe add like, 6 covered parking or 10 covered parking to get some extra rent. So remember, I added $1,000 extra for year 2 for extra other income. So that was based on, getting some income from the car parking and, resort parking and things like that. So that's literally how we analyze. I mean, the whole idea is to put your business plan together and create a budget for that, right? For everything that you think you're going to do, it's going to come up with have a cost associated with that, and it's going to be a benefit associated with that. So we have to look at the cost benefit analysis and see, does it make sense for you to undertake that upgrade or undertake that additional thing? So that's a great question. That's the whole, literally that is essentially what goes into the analysis, right? So market analysis is a very important step, and we have to spend enough time to do that. And that's one of the reasons why we tell people in our coaching programs to say, focus on one city, right? Because you need to understand the market. Because if you're all over the place looking at deals all over the country, which is good when you're established, right? When you're starting out, it's better to understand the market, right? Because if you're looking at one market, now I'm in the Dallas market. So you're looking at the Dallas market. I know I've seen every property in Dallas market. We're looking at 100 unit plus C-class properties or B- properties. I've seen every property in the market. I know of every property in the market. I know what amenities are there. I know how much it costs to operate the property, right? It takes a little bit of experience to get to that level. But that's why another reason why you partner with people who already have experience, or you have a coach or a mentor who can help you to get there, right? Because they can look at they've looked at it several times. They know what to look for. So that's how you do it. You have to spend the time analyzing the market, properties, and comparing it.
Okay, one more question, and great answer. Very thorough, Joe. Appreciate that. The last question for tonight is, what do you look for, or what should, as a newer investor, what do you look for in terms of property management? Do you go with existing? Some investors want to do it themselves to save the money. Not always a good idea. So what should a newer investor getting into multifamily, what are the big considerations for finding a property manager?
Okay, so that's one of the challenges everybody has. So typically, if you're doing a smaller property, everybody has to, go through this, right? Because it's not easy to find a property manager for a smaller property, right? Because even if you have a 10-unit property, for example, the property manager is not going to make enough money for them to spend a lot of time at your property. You don't have on-site presence. So because you don't have on-site presence, you're going to have a lot of issues, right? Because people, you have to understand that if you're going after B- C-class properties, you're also dealing with the human aspect of it, right? People have issues, right? And then everybody's issue become your issue, right, as the owner, right, if you're managing the property, right? So it's always a challenge managing smaller properties. And I've been told not to do it, and I did it anyway and got burned. Not burned in the sense I didn't get burned, but literally, it kind of makes it very difficult. Your quality of life definitely would take a hit because you're dealing with 15 families who have issues every day, right? It could be simple as somebody parked in my space, or my toilet is overflowing, or whatever it is, right? So we don't recommend you do management yourself, because that's going to take away from your ability to grow your business, right? Now you get stuck in managing the property. So you should be looking at finding deals, analyzing deals, working with investors and growing your business, not managing the property. So now, what I recommend is, if it's possible, is look at a live-in manager, right? So if you can work out a way that somebody at the property, you hire them, or look at your state laws also, right? In some, if you owner, in some states may have specific laws about who can manage a property. So it also check that out. But what has worked for me is to have a live-in manager, like what we call the QB, right? Somebody who's going to be sit there. People can, they can coordinate the repairs up to a certain amount, and they can also, they can't collect rent if they're not, in some states, if you're not a licensed agent or a employee of the owner, you cannot collect rents, but they can, somebody can drop the checks off in their mail slot or whatever, right? So that's one way to do it. I haven't had much luck with smaller for management companies, because not their fault, right? Because they're not going to be able to babysit the property for you. You need somebody on site who's watching over the property for you. So maybe you use a hybrid approach. So you have a property manager who's going to collect the rents and do the accounting and reporting and everything. But you also have maybe work a deal with somebody in the property to kind of watch over the property, pick up trash, and things like that as well, right? So that is maybe a combination that works better. But that's one reason why a lot of people want to get to a 70 unit plus property, right? Because when you get to a 70 unit plus property, then you can have an on-site management, right? You can have a manager, assistant manager, leasing agent, a porter, a handyman, and everything, on site, right? So that removes a lot of that, takes a lot of that away from you, right? So, but I know it's not easy for everybody to get to a 100-unit property, but I know that's one of the reasons why people prefer 100 plus units, because the management becomes a lot easier because you have staff on site.
Right, that and tenant problems seemingly never happen between 9 and 5 on weekdays either. So that's another phase. So Joe, great answer.
Tell me about it. Yes.
Appreciate all your input and everything tonight. I want to get you back here later this year for another webinar, and I think we'll get into some other topics, since the replay of this will be up and available on our sponsors page and any of you that wanted to take another look at those charts and everything, we'll have the replay up in the next few days. So our thanks to Joe James, CCIM, for a great presentation tonight. Thanks to those of you who've attended, and keep an eye out for more live events and the online courses and everything with REI USA. And Joe, if you want to pop your contact info up there, I don't know if you've got the contact info slide up there real quick.
No, I don't have one, but I'll put our support email. So if anybody wants something, you can email our support team. So I'll put that in the chat. And okay. Dave, I'll send you this presentation, and then you can send it out to everybody who registered for the event.
Any of you that missed it, just let us know at REI USA. We will get it out there to you. And again, thank you so much, Joe, and everybody for attending. That'll do it for this one, and we thank you on behalf of REI USA.
Thank you, Dave. Thank you for the opportunity for having here. I'm welcome opportunity to come back here in the future.